In the span of 48 hours, a metal most people still think of as the cheaper cousin of gold flashed a warning that markets usually only send right before something breaks. Not months, not weeks. In 48 hours, the conversation around silver shifted from price chatter to supply math, the kind of math that doesn't care what anyone believes. A projected deficit of 67 million ounces for 2026 is not a mood. It's a hole. And if that hole is real, the market has only one way to fill it. It must keep draining above-ground inventory. When the system is calm, those distinctions don't matter. When the system is stressed, those distinctions become everything. What makes this moment different isn't one headline. It's that the people who actually use silver, not the people who talk about silver, are acting like the easy supply is gone. Manufacturers have started treating silver like a bottleneck input, not a commodity you can casually reorder. Solar module makers in particular are engineering their products to use less of it, and they're doing it because the numbers stopped being theoretical. Reports have described silver's share of solar module production costs rising to around 26%, up from roughly 3% just 3 years earlier. That's not a normal cost swing. That's a stress test. They watch inventories, spreads, and procurement behavior. They watch the quiet data, the kind of data that updates monthly, not hourly, but tells you where the physical metal is actually sitting. The story is that the market is trying to reconcile two realities that cannot both stay true. On one side, paper silver trades with the ease of a video game token. On the other, the physical silver that industry needs is being treated like a scarce component. Welcome to Signal Ledger, where we decode what matters before it becomes a headline. If you like analysis that starts with the numbers and ends with a pattern, you're in the right place. Subscribe if you want the calm version of the story, not the loud one, and drop a comment with where you're watching from, because this market behaves differently depending on where you sit in the supply chain. Now, the event itself isn't a single explosion. It's a series of measurements that, when lined up, look like a system leaning too hard on inventory. The London Bullion Market Association publishes vault data that acts as a window into one of the world's key storage centers. At the end of January 2026, the reported silver holdings in London vaults were 27,729 tons, a small decline month over month. Small changes are easy to dismiss, and that's exactly why they matter. In a tight market, even modest month-to-month erosion becomes a signal because it suggests the market is still using inventories as a balancing mechanism. At the same time, the silver narrative running through industry has turned sharply practical. Solar is often described as over a quarter of industrial silver use, which means one sector's procurement decisions can tilt the whole metal. And when silver's price rises enough, it doesn't just dent margins, it reshapes design. That's why you're seeing talk of thrift, substitution, and process changes. Not because companies enjoy redesigning for fun, but because they have to control inputs that suddenly behave like strategic risk. Here's where it gets interesting. The price mechanism most people watch is only one layer. There's also the availability mechanism, and it speaks in different signals: delivery lead times, regional premiums, and the simple fact of whether a fabricator can quote metal for immediate shipment without adding conditions. When a market is comfortable, those signals are boring. When a market is strained, those signals become louder than the chart. To make that concrete, think about what a projected 67 million ounce deficit implies in operational terms. Mines do not flip a switch and produce an extra 67 million ounces on command. A large share of global silver supply comes as a byproduct of mining other metals, which means more silver often requires more lead, more zinc, more copper, even if the world doesn't need more of those at the same pace. Recycling helps, but recycling also has timing. Scrap doesn't appear instantly because the price chart looks exciting. It appears when products reach end of life, get collected, processed, and refined. That lag matters. Now fold in the price shock that industry has been staring at. Reports have described silver rising roughly 300% in a short multi-year window, with prices discussed around $112 per ounce. Whether you consider that level sustainable is beside the point. The point is that at those levels, procurement managers are forced to treat silver like a risk factor, not just a line item. A cost share that climbs from roughly 3% to around 26% in 3 years isn't an inconvenience. It's the kind of shift that forces redesign, long-term contracting, and contingency planning. This is also where institutional behavior becomes visible if you know what to look for. When volatility rises in a metal that is heavily traded on leverage, the plumbing responds. Exchanges reassess margin requirements. Clearing members reassess risk. Dealers widen bid-ask spreads. Inventory lenders demand higher compensation to part with metal temporarily. None of that needs a press conference. It shows up as tighter financing and less willingness to warehouse risk. In past episodes, including the 2011 volatility window, the market saw risk controls tighten as prices moved, and the effect was not merely emotional. It was mechanical. Leverage becomes harder to carry. Forced selling becomes more likely, and volatility feeds on itself, and that leads directly into protect or produce decisions in manufacturing. If a solar producer is planning capacity for the next 12 months, it cannot base its cost model on a metal that can swing violently because of paper positioning. That's why you see aggressive efforts to reduce silver loading per cell, experiment with alternative pastes, and redesign interconnects. The interesting twist is that those efforts, once underway, don't reverse overnight. Even if prices ease, the lesson stays. Dependence on a scarce input creates vulnerability. Or, the crisis is that the market is being asked to allocate a critical input through a pricing system that can move faster than factories can adapt. When the paper market whipsaw becomes the signal that procurement has to respond to, the industrial side loses patience. It moves to contracts, prepayments, and strategic stockpiles. That is institutional movement in the real economy, and it can quietly tighten the spot market further. One more data point gives this shape. 27,729 tons sounds like an ocean until you translate it. It's roughly 892 million ounces sitting in London vaults on paper at the end of January 2026. Some is earmarked, some is already spoken for, and some is simply in the wrong hands for the wrong price. That's why the same day you can see a clean, single spot price on a screen, you can also hear the physical market speaking a different language in premiums and timing. When those micro signals persist, they eventually force the headline price to follow reality too. In practical terms, silver moves through a chain, or becomes concentrate. Concentrate becomes refined metal. Refined metal becomes bars, grain, powder, or specialized forms that manufacturers can actually use. Every step has capacity limits, financing needs, and scheduling. A market can have plenty of silver in theory, while still having not enough of the right form in the right place at the right time. That's how shortages show up in the real world, not as a total absence, but as friction that keeps spreading until it becomes a constraint. Now, layer in a second reality, the way silver is traded. A huge portion of the market is paper exposure. Contracts can be bought and sold instantly. Positions can be leveraged. Narratives can whip price around. That trading layer is not inherently bad. It provides price discovery and hedging. But it also creates a situation where the amount of silver traded can be many multiples of the amount of silver that would ever be delivered. When confidence is high, nobody cares. When confidence is questioned, people start asking what would happen if more participants wanted physical settlement than the system is designed to handle. That question becomes sharper when the supply-demand balance is already tight on the physical side. A projected deficit of 67 million ounces means the market expects to need inventory again to balance. And inventories are not infinite. Even worse, inventories are not uniformly liquid. Some are strategic, some are pledged. Some are simply held by owners who won't part with it unless the price changes dramatically. The headline number looks large, but the tradable slice can be surprisingly small. Notice the contradiction. If silver is truly abundant and easy to source, why would manufacturers race to thrift it out of their products? If supply is comfortable, why redesign at all? Companies redesign when an input becomes unpredictable, expensive, or both. That's the central mystery. The market's paper side still signals liquidity, while the industrial side signals constraint. To understand why this matters, you have to zoom out and see the hidden pattern. Commodity crises rarely start with price spikes alone. They start with small, persistent imbalances that only show up in the accounting. The deficit comes first, then inventory starts doing unnatural work. Then users begin altering behavior, and only after that does the public story catch up. We've seen versions of this playbook before, not just in silver, but across commodities. In 1979 and 1980, silver became a case study in what happens when positioning collides with thin physical availability. The result wasn't just a higher price, it was a market that discovered its own fragility under stress. In 2010 and 2011, silver itself experienced a dramatic run where attention arrived late. Liquidity tightened and volatility became the story. The specifics were different, but the sequence rhymed: steady imbalance, then stress, then dislocation. In 2020, the world got a real-time lesson in what happens when financial markets and physical logistics collide. Supply chains broke in ways that spreadsheets didn't predict. Premiums disconnected from spot prices. Delivery times became the headline. Or that lesson matters now because silver sits at the intersection of finance and manufacturing. Silver is a monetary metal in the way it trades, but it's an industrial metal in the way it gets consumed. And consumption is different from investment. When an investor sells, the metal can return to the market. When a factory uses silver in a product, that metal is dispersed. It's soldered, plated, embedded, and shipped. It doesn't casually come back. That is why persistent deficits are so important. A projected deficit of 67 million ounces for 2026 implies that the market expects demand to exceed supply again, requiring inventories to fill the gap again. A one-year deficit can happen for many reasons. A multi-year sequence of deficits is a different kind of event. It means the balancing mechanism has shifted from mine more to use stockpiles, and stockpiles are finite. Now let's talk about the players, because markets don't move as abstract forces. They move through institutions, exchanges, refiners, vaults, and industrial buyers. On the trading side, exchanges and bullion banks provide liquidity through standardized contracts. That system works because most participants settle financially, not physically. The contracts are designed to be traded, not necessarily to result in someone showing up with a truck. On the physical side, refiners and fabricators turn raw metal into forms that industry can use. Vault operators store and move bars under specific rules, and large industrial buyers manage procurement like a battlefield, not a shopping trip. They sign supply agreements, they diversify sources, they prepay, they hedge. They do everything possible to avoid being forced into a spot market scramble. The coordination you should notice is not a secret meeting, it's timing. When deficits persist and inventories trend lower, procurement behavior changes. It's subtle at first. Buyers start asking for longer contracts. They start requesting delivery flexibility. They start paying attention to different regions. And when enough buyers do this, the market's available supply shrinks even if total supply hasn't changed. There's another layer here, and it's the way markets behave when they are relying on inventories. The first stage is denial. People say the inventory is still large. They point to tons and ounces as if size alone guarantees function. But inventories are not homogeneous. Some inventory is held as strategic reserve, some is tied up in ETFs, some is owned by long-term holders who don't sell into modest rallies, some is in locations that don't easily flow to where it's needed, and some is simply not the right bar form for the right contract. So when London Vault data shows 27,129 tons at the end of January 2026, that's a number, but it's also a question, how much of that is actually available to meet incremental demand at the margin? Because markets are set at the margin. You don't need the entire inventory to be unavailable for stress to appear. You only need the marginal supply to tighten. This is where the dislocation begins, and it's the part no one is discussing with enough precision. The paper market can reflect optimism, fear, leverage, and macro narratives. The physical market reflects logistics, fabrication capacity, and real-world consumption. When those two drift apart, you get a confusing picture. Prices that say one thing, availability that says another. Think of it like airline tickets. In calm times, the price you see online is roughly aligned with seat availability. In stress times, the posted price might still exist, but the seat you want isn't actually there, or it comes with conditions. Silver behaves similarly. A quoted price is not always a promise of immediate, frictionless delivery. Now, why can't this gap persist? Because industry doesn't operate on narratives. A factory can't pause because a chart looks stretched. A manufacturer doesn't ship a solar panel made of good intentions. If a critical input becomes constrained, the factory either secures supply, substitutes, or slows production. Those are the only options. And each option has consequences that ripple outward. Let's lay out the evidence with numbers because this is not opinion. Start with the projected deficit, 67 million ounces for 2026. That number, if accurate, represents an annual shortfall that must be filled by inventory drawdowns or demand reductions. Now layer in the monthly vault data, 729 tons in London at end January 2026, slightly down on the month. 1 month doesn't make a trend, but it does establish a direction at a time when the market is already forecast to be short. Then add the industrial cost pressure. Silver's share of solar module production, costs reportedly rising to around 26%, compared to roughly 3% 3 years earlier. That's a massive change in a short time. When input costs move that fast, management behavior changes. Engineering becomes procurement. Procurement becomes strategy. And finally, add the behavioral evidence. Manufacturers actively working to reduce silver usage. That is demand-side adaptation, and it happens when supply-side reliability is in question. If silver were simply expensive but available, many firms would absorb costs temporarily. If silver is expensive and potentially constrained, they change the product. Now, here's the mechanism that turns this into market volatility. When a market runs deficits, it quietly transfers metal from hands that hold inventory into hands that consume it. Over time, that reduces the buffer. The buffer is what absorbs shocks. When the buffer shrinks, small disruptions produce larger effects. A refinery delay, a shipping bottleneck, a surge in procurement, or a funding squeeze can suddenly matter. At the same time, the trading system built on paper contracts assumes that physical delivery is the exception, not the rule. Most participants don't want bars. They want exposure. That's fine until enough participants, for enough reasons, start caring about physical. Sometimes that happens because of a price move. Sometimes it happens because of distrust. Sometimes it happens because industrial users are forced to compete with investors for the same metal. You can picture it with a simple analogy. Imagine a town where most people trade water coupons, not water. The coupons are easy to trade and most people never redeem them. Then a drought hits. Suddenly, a small percentage of coupon holders decide to redeem. The system can handle a few redemptions. It cannot handle a wave. The coupons didn't change. The behavior did. And behavior changes when scarcity becomes plausible. This is where forward analysis becomes useful, not as prediction, but as pattern. Historically, when a commodity market enters a persistent deficit and inventories become the balancing mechanism, you tend to see one of three outcomes. In a conservative scenario, supply improves modestly, demand growth slows, and the market remains tight but functional. Prices can still be volatile, but the system doesn't break. The key signal in that scenario is stabilization in inventories and normalization in premiums and delivery times. In a moderate scenario, deficits persist and inventory drawdowns continue, but industry adapts through thrift and substitution. That reduces demand growth, but it also confirms that the market has entered a scarcity mindset. In an aggressive scenario, a disruption hits while inventories are already thin. That could be a supply interruption, a sudden surge in procurement, or a financial event that changes how participants treat paper claims. Historically, that's when dislocations widened. Spot prices, regional premiums, and financing rates can move in different directions, confusing anyone who expects one clean price. So what should be watched if you're tracking this as an analyst? Watch the measurable signals that don't rely on feelings, monthly vault holdings, reported deficits, the cost share pressure in key industries like solar, evidence of substitution and thrift, and the behavior of spreads and premiums, because those are the market's way of telling you where the real tightness is. Now we get to the divide, because every major market stress creates one. It's not a divide between smart and not smart. It's a divide between those who look at the underlying mechanics and those who only look at the headline price. Institutions tend to live in the first group because they have to. Industrial buyers have deadlines. Banks have risk systems. Exchanges have to maintain orderly settlement. They move first because they're watching the constraints, not the story. Retail tends to move last because retail is invited into the conversation after volatility arrives. That's why information gaps become wealth gaps in markets, even when no one is trying to create them. The data is available, but attention is scarce. Most people don't track vault data. Most people don't think about cost shares in solar modules. Most people don't connect multi-year deficits to the concept of a shrinking buffer. But that is exactly how stress builds quietly. And here's the final point that ties it together. The silver supply story is not about one dramatic day. It's about a system that is being asked to do two incompatible things at once. Support a massive liquid paper market and feed a growing industrial demand base that consumes the metal irreversibly. When the market is balanced, it can do both. When the market runs deficits year after year, it starts choosing, and the choice shows up as dislocation. So if you're wondering why the tone around silver has changed, it's because the participants closest to the metal are behaving differently. And markets always reveal the truth through behavior first, headlines second. This is Signal Ledger, where we decode what matters before its headlines. If this connected dots you hadn't lined up yet, you know what to do. The question isn't whether the market will keep wrestling with this mismatch. The question is whether you'll recognize the signals while they're still quiet.